Hi, my name is Jesse Hooten. I'm a CFA looking to do some equity research on Alimentation Couche-Tard today. We'll refer to it as ATD. Alimentation Couche-Tard, a convenience store leader operating in North America, Europe, as well as Hong Kong. Their stated goal to provide fast service, providing beverages, fresh food, EV charging, as well as fuel for vehicles at their locations, meeting the needs of people on the go. The valuation or value creation strategy for ATD is to gain market share through acquisitions in the US, given the US's fragmented market when it comes to the convenience store sector. In Canada and Europe, the market is less fragmented. Nonetheless, there remains significant synergies to be unlocked through bridging across their network, bridging gaps across their network in the region. Scrolling down now, we're going to go through some ratios that I've prepared for the company to give us an overview of some of their fundamentals. I'm going to finalize the video with a discounted cash flow valuation as well. So let's go down. We'll start with gross margin here. You can find a more in-depth review through my Substack, which I will provide a link below. But just to start here, the gross margin, we can see recovery from the low in 2023 to 17.87 in 2025. This is driven by higher margin in the merchandise and services sales versus lower margin fuel sales. When it comes to this ratio, as food and merchandise sales takes a larger share of revenue, I expect to see gross margin trend upward. Onward to operating margin. This ratio, despite operating profit holding steady, operating margin fell as revenue grew from 45 billion in 2021 to 72.8 billion in 2025. As recent acquisition begin to integrate and pivot to higher margin merchandise and services sales, we expect to see incremental expansion in this margin as well. On to free cash flow margin. You'll notice the steady 4% free cash flow margin over the last 4 years. With free cash flow so stable, ATD can fund acquisitions without needing to turn to the high interest 2026 debt markets, which signals a resilient business model. Okay, looking now to both receivables turnover as well as the commensurate days sales outstanding. One is very connected to the other. Essentially, receivables turnover fell from 30 at the beginning of the decade to 2025 to 25 in 2025, reflected in days sales outstanding lengthening to 15 days from 12 days in 2021. This confirms a slowdown in cash collection. Essentially, this means cash is being held in the customer's pocket and not available to be used by ATD for a period of 3 days longer versus 2025 versus 2021. The 15-day days sales outstanding, the 25 receivables turnover in 2025, still considered healthy for a large conglomerate. However, investors should monitor these figures as it could signal loosening credit standards. Okay, moving down. We have asset turnover, but I'm going to leave that for later as we'll go through a ratio that already includes that. We'll go to return on assets. Essentially, this ratio, it's an efficiency ratio, how many dollars of revenue or net income per dollar of assets. essentially 7%. The low in 2025, dipping from the high in 2023, despite net income remaining stable, suggesting a lag in what's called capacity utilization, meaning recent acquisitions have not yet been realized in the form of net income. Look for return on assets to return to a double digit average as to return to their long term double digit average as management integrates new assets and applies their higher margin food program. Moving down to return on equity, what's called the DuPont decomposition. Essentially, it takes the profit margin, financial leverage, and asset turnover of the company and multiplies those three ratios to determine the return on equity. What you'll find is return on equity has moderated to 18% from its peak in 2023. Return on equity increasingly appears to be supported by financial leverage. If this continues, that could be viewed as an impairment to return on equity as the company is relying more on its balance sheet and taking on more debt to support returns as opposed to a more sustainable or organic measures such as asset turnover or profit margin. If this trend continues, quality of return on equity may be viewed as impaired, and the market may determine the direction of the share price may be determined by this factor going forward. Down to return on invested capital. So essentially, with this metric, when return on invested capital is greater than the company's weighted average cost of capital, the company is creating value. When it's less than the weighted average cost of capital, that's wealth destruction. The company is destroying value. So in this case, we're seeing a 10% return on invested capital in 2025. Given the high interest rates in 2026, this could suggest a narrowing between the return on invested capital spread over weighted average cost of capital. Waiting to see if management can return the return on invested capital to the 13 to 15% range by realizing synergies from their acquisitions. The direction of this metric could determine market action from here on forward. So those are some key performance indicators that I've put together to give a general idea as to the direction of the company, the current position of its performance. As far as a valuation, I rely on free cash flow to equity. I find that to be the most reliable. What I have in this table here in the top row is long-term growth rates. That's a growth rate 7 years from now. Over the next 7 years, I assume a short-term growth rate of 10% for this company, in line with their return on invested capital from 2025. On the left-hand side, the vertical axis, we see discount rates from 8 to 12%. So anywhere in this range, in my opinion, we would find the true intrinsic value of the company based on its free cash flow to equity, discounted at the various discount rates on the left. So you'll see most likely, in my opinion, considering a long-term growth rate of 3 to 4% is most reasonable, roughly in line with GDP growth. Meaning if it's say 4% long term after a 10% short term growth rate over the next 7 years, given the current market price in US dollars, all figures today are in US dollars, of $58.43 as of April 8th, 2026, end of day. If you're considering a long term terminal growth rate of 4% after 10% growth over the next 7 years, you'll look to see anything higher than an 8% discount rate, the company is perhaps overvalued. If you believe the discount rate is below 11%, let's say, but long term, the growth rate would be 5% or more, then perhaps the company is undervalued. It's up to you to determine where in this graph here the fair valuation would fall based on discount rates and long-term growth rates, the risk of the company, etc. But right here is my methodology as far as how to determine this discounted cash flow analysis. My recommendation for the company based on figures gone over today, I'm recommending a hold. My rationale, the 15 to 10% return on invested capital suggests profits have not caught up with capex. The company has successfully acquired massive assets, but net earnings have not reflected those acquisitions as of yet to justify anything more than a hold recommendation at this time. Similarly, my discounted cash flow sensitivity suggests there isn't enough of a margin of safety to justify a buy recommendation at this time, which is why I'm keeping it at a hold. To shift to a buy would be triggered by a reversal in asset turnover, as well as net profit margins, signaling that the synergies from acquisitions have come to fruition, which signals a stronger future for the company. This time it's a hold recommendation. You can see a more in-depth analysis through my Substack, which I'll provide in the link. However, that's all for today. Thank you.